What if everything you thought you knew about the Great War overlooked the most crucial element of the narrative? Most people assume it all began with the assassination of an Austrian archduke in Sarajevo. But that's akin to saying the Titanic sank because it struck ice. While that was the visible trigger, what if the underlying cause was entirely different? A financial crisis that had already pushed Europe's major powers to the brink of insolvency decades before the first shot was fired. What if I told you that Europe's great powers were already bankrupt long before any hostilities commenced? What if the assassination was merely the pretext they needed to resolve a financial crisis that threatened to shatter their empires? Allow me to demonstrate how escalating debt transformed political rivalries into financial imperatives, and how the most catastrophic military engagement in human history was, in fact, the world's most expensive debt consolidation scheme. The story commences in the 1850s, when European powers discovered a revolutionary concept that would irrevocably alter the global landscape. They could borrow money to build empires more swiftly than they could generate wealth through conquest. Great Britain pioneered this approach, extending vast loans to fund railway expansion across India, established naval bases on 6 continents, and maintained the largest military force the world had ever witnessed. This system functioned flawlessly as long as the empire continued to expand, generating new revenue streams. But this is where the mathematics becomes precarious. By 1914, Britain's national debt had ballooned to £650 million, an astronomical sum necessitating meticulous management of interest payments and continuous refinancing. France, Germany, and Russia adopted a similar strategy, each accumulating substantial debt to fuel their imperial ambitions. They believed they were engaged in territorial expansion. In reality, they were playing a game of compound interest. Consider your own mortgage for a moment. You likely meticulously calculated your monthly payments, ensured you could manage the interest rate, and perhaps even secured pre-approval before embarking on your home search. Now imagine if your neighbor was also buying houses and the next neighbor was acquiring even larger properties. Suddenly, you'd feel compelled to purchase more homes just to keep pace. This is precisely what transpired with Europe's great powers, except instead of houses, they acquired battleships, armies, and entire continents. Germany presents the most striking illustration of this imperial debt spiral. Under Kaiser Wilhelm, German borrowing surged as the nation sought to challenge British naval supremacy while simultaneously constructing railways across Africa and establishing colonies in the Pacific. The German government became convinced that each new territorial acquisition would generate returns through resource extraction and trade revenue. Sound familiar? It's the same logic that fueled our housing bubble in 2008, the conviction that escalating asset values would perpetually offset rising debt obligations. The truly shocking revelation, however, emerges when examining the Ottoman Empire, a stark preview of what occurs when imperial debt spirals out of control. In 1875, the Ottoman government declared bankruptcy, burdened by debts totaling £200 million. And here's the kicker: their annual debt payments exceeded half of their national revenue. European creditors did not simply absorb the loss. They established the Ottoman Public Debt Administration, which granted foreign bondholders direct control over Turkish tax collection and public spending. Reflect on this for a moment. A sovereign nation, controlling territory across 3 continents, effectively became a subsidiary of European banks. Ottoman sultans might have retained their ceremonial robes and prestigious titles, but the actual financial decisions emanated from London, Paris, and Berlin. This was more than just debt restructuring. It was the blueprint for modern financial colonialism. The London Declaration of 1914 formalized this dangerous game, preemptively recognizing merit as an integral component of the Anglo-French-Russian alliance. Military partnerships were now explicitly linked to financial partnerships. When you enlisted as an ally, you weren't merely agreeing to fight together. You were agreeing to incur debt together, guaranteeing each other's liabilities and sharing the financial risks of imperial competition. By 1914, all major European powers found themselves trapped in the same untenable predicament. They possessed colossal debts that necessitated continuous territorial expansion to service. However, territorial expansion demanded even greater borrowing, thus creating larger debts. The system had become mathematically unsustainable. Something had to give. Either these empires would devise a method to drastically increase their revenues, or they would face financial collapse. War, it turned out, offered both a solution and a convenient excuse. Military victory would grant access to enemy territories and resources, potentially resolving the revenue shortfall. Wartime exigencies would legitimize levels of public borrowing that would be politically unfeasible in peacetime. And most crucially, war would enable governments to restructure all their financial relationships, both with their own citizens and with international creditors. These European emperors were not expanding their empires. They were accumulating liabilities that would ultimately consume everything they claimed to protect. And this is where the story becomes truly compelling, because in 1916, something unprecedented was unfolding in global finance. Great Britain was not merely financing its own war effort, it was underwriting the majority of the empire's expenses, all of Italy's war costs, and 2/3 of France's and Russia's military expenditures. Consider this for a moment. A single nation was essentially footing the bill for a world war involving dozens of countries. How did this financial arrangement function? The answer lies in a web of international banking relationships that most people have never heard of, yet which dictated the fates of millions. Once you understand how these financial arrangements truly operated, the entire war begins to resemble less a political conflict and more a massive debt collection operation, employing armies instead of bailiffs. Let's begin with a question that should capture our attention. Why did JP Morgan Jr., an American banker, orchestrate military supply contracts for European armies 2 years before America entered the conflict? In 1915, Morgan assembled a consortium of 2,200 American banks to extend a $500 million loan to the Allied powers. But here's the crux. This wasn't merely a loan. Every single British munitions purchase had to pass through Morgan's firms, giving American financiers direct control over European military procurement. Pop quiz. When a foreign bank controls your military supply chain, are you still a sovereign nation, or have you become something entirely different? Great Britain, the empire that commanded a quarter of the world's landmass, had effectively outsourced its war financing to Wall Street. The lion was borrowing from the eagle to purchase bullets. But the truly absurd aspect is what happened to interest rates during this period. As European governments borrowed increasingly vast sums to fund their military endeavors, the cost of borrowing continued to escalate. Higher interest rates meant that territorial expansion was not merely politically desirable, it was mathematically imperative. New revenue streams were essential simply to service existing debt, let alone fund new military campaigns. France and Russia found themselves in a particularly precarious position. Their gold reserves, which financial records indicate far surpassed those of the Bank of England, became a critical leverage point in alliance negotiations. When you negotiate military alliances, you aren't just promising to fight together, you are promising to share the financial burden of keeping each other's government solvent. And this is where the situation becomes almost surreal. The German Reichsbank provided short-term credit to the government, while war loans consolidated long-term debt, creating what finance historians now recognize as an early iteration of debt monetization. The German government was essentially printing money to pay the interest on money it had already borrowed to fund military operations that were supposed to generate enough plunder to repay the original loans. Does that sound familiar? It's the same cycle that led to the 2008 financial crisis. But instead of mortgage-backed securities, the European powers were betting on victory-backed securities. Each new military campaign was expected to pay for itself through territorial conquest, resource extraction, and reparations from defeated enemies. The Bank of England, the Rothschilds, the Beilings, the Morgans, the Kleinworts, and the Schroders, the 5 great merchant banks of London, dominated international investment initiatives and held immense financial stakes in the outcome of European conflicts. They were not neutral observers providing banking services, they were active participants whose bond portfolios depended on specific military results. Let me put this into perspective with a modern analogy. Imagine if Goldman Sachs, JP Morgan Chase, and Bank of America had lent billions of dollars to different parties in a regional conflict, with the loan terms contingent on who won the war. Now imagine these banks also controlled the arms suppliers for each side. Do you think these banks would remain neutral, or would they have strong incentives to influence the outcome? This is precisely what transpired in Europe between 1914 and 1918. International lending had created interdependencies where creditor nations had a vested interest in the military success of their debtors. When Great Britain lent money to France and Russia, British banks weren't just hoping for repayment, they were betting on an Allied victory. When German banks financed Austrian military operations, they were making the same kind of wager on Central Power's success. The result was a financial system where military defeat meant not only political humiliation, but also complete economic collapse. Losing the war meant defaulting on international loans, losing access to global credit markets, and facing foreign financial control, much like the Ottoman Empire had already experienced. By 1916, credit restrictions and soaring interest rates had rendered territorial expansion the only viable strategy to avert bankruptcy. The European powers were not fighting for glory, nationalism, or even strategic advantage. They were fighting to avoid the financial equivalent of foreclosure. The war had devolved into an enormous game of musical chairs where whoever stopped fighting first would face complete economic devastation. This is why the conflict escalated so rapidly and became so brutally total. It wasn't enough to win a few battles or negotiate a favorable peace treaty. Both sides required outright victory to generate sufficient plunder and reparations to satisfy international creditors. Any victory less than total victory would mean financial ruin that would persist for generations. The human cost of this financial logic was staggering, but the banking system had created incentives that made peace more perilous than war for heavily indebted governments. When your nation's survival hinges on borrowed money and your ability to borrow depends on winning military conflicts, you cannot afford the luxury of choosing peace. Now we arrive at the portion of the story that fundamentally alters your understanding of America's role in the Great War. You've likely heard that the United States sought to remain neutral until German submarines forced our hand. That is the official narrative. The true story involves a man named J.P. Morgan Jr. and the greatest financial gamble in human history. Picture Morgan in his Wall Street office in 1915, surrounded by maps of Europe dotted with red pins indicating battlefields where American money was funding the carnage. By this point, Morgan had arranged loans totaling $1.5 billion to the Allied powers. That's approximately $35 billion in today's currency. But here's what makes this utterly preposterous. Morgan wasn't just lending money. He was, in effect, running Great Britain's entire military procurement operation from Manhattan. Every British munitions purchase, every French artillery order, every Russian rifle contract had to pass through Morgan's firms. The man controlling the Allies' arms supplies was an American banker whose profits depended on the war lasting long enough for the Allies to win decisively. Consider the conflict of interest this creates. Morgan had every financial incentive to prevent peace negotiations that could have ended the war before the Allies could accumulate enough plunder to repay American loans. But Morgan was merely the beginning. By 1917, the situation had escalated far beyond private banking. The U.S. Treasury was extending massive loans directly to European governments, with the United States lending over $10 billion to foreign nations, an astronomical sum that transformed the global financial system overnight. The U.S. shifted from being a net international debtor of $3.2 billion in 1914 to becoming the world's largest credited nation by 1918. And this is where the timing becomes suspicious. The Federal Reserve, the central banking system of the United States, was established in 1913, just 1 year before the war erupted. Coincidence? The Fed provided the institutional framework that made massive debt monetization of the war effort possible. Without the Federal Reserve's capacity to expand the money supply and coordinate with private banks, the scale of American lending to Europe would have been financially impossible. Let's examine what this means in practical terms. America's entry into the war was not merely a matter of submarines or diplomatic tensions. By 1917, American banks and the U.S. government had lent so much money to the Allied powers that their defeat would have triggered the largest financial crisis in American history. Morgan and his partners weren't just hoping for an Allied victory. They desperately needed it to avoid bankruptcy. Consider this scenario. You lend your life savings to a friend who's in a fight with someone else. If your friend loses the fight, you never see your money again. If your friend wins, you get your money back with interest. Would you remain neutral in that fight, or would you do everything in your power to help your friend win? This is precisely the situation America found itself in by 1917. The transformation was remarkable. In just 3 years, the United States went from a neutral observer to an active participant, not because of political ideology or military strategy, but because of financial exposure. America's entry transformed inter-allied credits from a hybrid public-private network into direct governmental lending relationships, with the United States as the ultimate global creditor. But here's the part that should truly capture our attention. As the European powers bled themselves dry in the trenches, American industrial capacity exploded. The Allies' massive purchases of American arms, food, and raw materials reversed our international debt position and laid the groundwork for American economic dominance that would last for the next century. Morgan and his partners had essentially figured out how to profit from European self-destruction. They weren't financing a war, they were financing the transfer of global economic power from European empires to American financial institutions. Every artillery shell fired in France, every tank that rumbled across Belgian fields, every battleship sunk in the Atlantic represented debt payments flowing from European treasuries to American banks. The human tragedy here is staggering. European soldiers died in the trenches defending bond portfolios held by American financiers who had never seen a battlefield. Young men from British farms and German villages killed each other to decide whether Morgan's loans would be repaid in pounds, sterling, or defaulted upon entirely. When America officially entered the war in 1917, our participation was essentially inevitable. We weren't choosing a side based on democratic values or humanitarian concerns. We were protecting a financial investment that had become too big to fail. American soldiers shipped to European battlefields were not fighting for freedom or democracy. They were fighting to collect the debts that the European powers owed to American banks. The scale of this financial manipulation becomes clear when you examine the numbers. Through Morgan's private syndicate and the Treasury's direct loans, American financial institutions controlled the outcome of the world's greatest military conflict. The European empires that had dominated global affairs for centuries found themselves financially beholden to a nation most of them had considered a former colony just decades prior. This was no accident. The very same financial institutions that had previously fueled cycles of boom and bust in American railway construction and industrial expansion had simply broadened their scope to encompass entire continents. They had mastered the art of monetizing international disputes on a scale unimaginable to prior generations. The true brilliance of the American position lay in its ability to profit regardless of the war's duration or the tragic toll of lives lost. Prolonged conflicts translated into increased loan interest, escalated arms sales, and enhanced opportunities to establish financial dominance over their European counterparts. American banks had stumbled upon the ultimate business model, extending credit to all warring factions while simultaneously controlling the supply chains that dictated military outcomes. We now find ourselves at a juncture where the entire edifice of this financial structure stands exposed. And it is then that one grasps why the war to end all wars effectively cemented the perpetual debt-based international order that persists to this day. What transpired following the armistice was not peace. It was the most colossal debt restructuring operation in human history, artfully disguised as treaty negotiations. And here lies the truly startling revelation. By 1919, the United Kingdom's national debt had ballooned from a mere £76 million in 1914 to a staggering £7,481 million by the war's conclusion. This represented an increase of more than 10 times its original sum. France, Russia, and Germany faced comparably explosive debt increases, rendering normal peacetime governance financially untenable. These were not merely astronomical figures, they signified obligations that would consume national budgets for generations to come. However, the profound truth emerges when tracing the flow of capital after the Treaty of Versailles. Germany was compelled to pay substantial reparations to Great Britain and France, but here's the crucial twist. Germany financed these reparation payments through loans secured from American banks. Subsequently, Great Britain and France utilized the reparation funds received from Germany to settle their own debts owed to the United States. The entire arrangement constituted a circular debt scheme, whereby American banks essentially lent money to Germany to pay reparations, which then flowed back to the American creditors. Let me meticulously elucidate this financial sleight of hand. Between 1919 and 1932, Germany disbursed 19 billion gold marks in reparations to the Allied powers. During that same period, Germany received loans amounting to 27 billion gold marks from American banks. While Germany was borrowing more money than it was disbursing, the reparations payments created a legal framework for perpetual financial oversight of Germany's internal policies. Consider the implications. The Treaty of Versailles was not, in essence, a peace accord. It served as a debt collection mechanism that positioned American financial institutions as the ultimate arbiters of European economic policy. German reparations, British war debt repayments, and French reconstruction loans all channeled through the very same American banking networks that had initially financed the conflict. The human cost of this resolution was devastating, yet the situation intensifies when one realizes that European governments were fully aware of what they were signing. According to financial records of the era, European sovereigns had incurred debts during the war, believing they were defending civilization. However, they discovered that the Americans viewed international loans as commercial investments aimed at maximizing profit rather than as support for allied nations. This engendered a fundamental divergence in expectations that would define international relations for the subsequent century. European powers anticipated debt cancellation or favorable restructuring based on shared sacrifice and common values. American creditors, conversely, expected full repayment with interest, predicated on standard commercial terms. When these conflicting expectations collided, the result was economic policies that prioritized debt servicing over human welfare. The extent of this financial control becomes palpable when examining the duration of these obligations. The final installment of Germany's World War I debt was not settled until October 3, 2010. Reread that. 2010. Germany spent 92 years repaying a war that lasted 4 years. British war debt payments to the United States continued until 2006. France did not complete its World War I debt payments until 2009. This signifies that individuals born decades after the armistice spent their entire working lives paying taxes to honor debts incurred by governments that had ceased to exist before their grandparents were born. The war had concluded, but the financial obligations forged a perpetual system of international wealth transfer, operating independently of shifting political landscapes. But here is the part that should truly ignite our indignation. As ordinary Europeans spent the next century servicing this financial arrangement, the banking institutions that had engineered the debt spiral amassed unprecedented power and profitability. World War I laid the groundwork for modern sovereign debt crises, wherein military conflicts serve as opportunities for financial institutions to establish permanent revenue streams through public borrowing. This pattern has repeated throughout the 20th century and continues to this day. International conflicts generate emergency borrowing situations that allow financial institutions to exert long-term control over national economic policies. The demands of debt servicing thus shape national priorities for generations, irrespective of democratic preferences or changes in political leadership. When this system is understood, current events begin to coalesce. Why do sovereign debt crises invariably lead to austerity measures that benefit international creditors while burdening ordinary citizens? Why do military conflicts systematically result in increased public debt rather than diminished international tensions? Why do peace negotiations consistently involve intricate financial agreements that appear to hold greater significance than territorial or political settlements? The answer is that World War I established a precedent wherein international conflicts primarily serve to consolidate debt rather than resolve political or territorial disputes. Modern wars are not waged to settle international disagreements. They are fought to create financial obligations that generate enduring revenue streams for international creditors. The European emperors with whom we began convened in opulent palaces with quill pens poised above crucial documents. They were not signing treaties to expand their empires. They were signing loan agreements that would ultimately lead to the bankruptcy of their nations and the creation of a global financial system where human welfare became subordinate to the imperatives of debt servicing. The war to end all wars did not end war. It made war perpetually profitable. Every international conflict since 1918 has followed this fundamental template. Emergency loans create long-term financial obligations that endure for decades beyond the original political disputes. We do not inhabit a world shaped by the outcomes of historical conflicts. We inhabit a world shaped by the financial agreements that finance those conflicts. And this, more than any assassination, alliance system, or imperial rivalry, explains why our current international order prioritizes financial stability over human security, debt servicing over democratic governance, and creditors' rights over national sovereignty. The bankers won World War I, and we are still living with the consequences of their triumph.